There is a ghost in your portfolio. It's an invisible force, a silent partner in every decision you make, and right now it's probably the single biggest threat to your financial future. It doesn't show up on any balance sheet or stock screener, but its influence is everywhere. This ghost is the echo of your own voice, amplified and reflected back at you by the people you trust the most. It's the comforting nod of agreement from a friend, the shared frustration over a stock that went down, the collective excitement for a trend everyone is talking about. It feels like support. It feels like validation. But in the world of high-stakes capital allocation and wealth management, it is a slow-acting poison. You believe you are making rational, data-driven decisions. You've done your stock analysis. You've read the reports. You've developed a thesis. But what you may not realize is that your entire process is being conducted inside a carefully constructed echo chamber, a room lined with mirrors that only show you what you want to see. Every friend who thinks like you, every article that confirms your bias, every social media feed curated to your worldview, they are all reinforcing the weakest parts of your investment mindset. They are systematically blinding you to risk. They are costing you money. This isn't about having bad friends. It's about having the wrong kind of intellectual environment. It's about the catastrophic danger of consensus. The most successful investors in history did not achieve their legendary status by seeking agreement. They achieved it by waging a relentless, internal war against their own certainty. And the greatest general in that war, the ultimate weapon against the seductive comfort of the echo chamber, was not a person who said yes. It was a person whose entire intellectual purpose was to say no, or, more accurately, to say, "Is that really the best you can think of?" For over 6 decades, Warren Buffett, the most celebrated investor of our time, has had such a weapon. His name is Charlie Munger. Their partnership is not a story of friendship, though it is that. It is the story of a deliberately engineered system for better thinking. It is a living testament to the idea that the most valuable person in your financial life is not the one who shares your winners, but the one who vigorously, intelligently, and relentlessly attacks your best ideas before the market has a chance to. Munger wasn't just Buffett's partner, he was his designated devil's advocate, the antithesis to his thesis, the person whose intellectual friction created the spark of genius that built the empire of Berkshire Hathaway. What you are about to learn is not another stock-picking strategy or a new way to read a chart. It is far more fundamental. This is a blueprint for rewiring your decision-making process at the source. We are going to deconstruct the Buffett-Munger dynamic and extract from it a powerful mental model that you can build for yourself. We will explore the deep psychological traps that an intellectual echo chamber sets for you, and the precise, actionable steps you can take to escape it. You will learn how to build your own mental team, a personal board of directors composed of challengers, not cheerleaders. This isn't just about avoiding bias. It's about weaponizing dissent. It's about forging your ideas in the crucible of criticism so that what emerges is hardened, tested, and ready to face the unforgiving reality of the market. This is the path away from the 99% who lose money to their own psychology and toward the 1% who achieve true financial freedom by mastering their own minds. The transformation begins not by changing what you invest in, but by fundamentally changing how you think. And it starts with understanding the origin of the most profitable intellectual alliance in modern history. The story begins not in a boardroom but at a dinner party in Omaha, Nebraska in 1959. Warren Buffett was 29 years old, already a local legend running his own investment partnership with a ferocious intensity. He was a disciple of Benjamin Graham, a quantitative prodigy who saw the world as a collection of mispriced assets, of cigar butts on the street. Unloved, discarded companies that had one good puff of profit left in them. He was a hunter of bargains, a numbers man, a human calculator who could tear through a balance sheet and find hidden value where no one else was looking. His friends, eager to introduce him to another of Omaha's brilliant minds, set up a dinner with a 35-year-old lawyer named Charles T. Munger. Munger had also grown up in Omaha, had even worked at Buffett's grandfather's grocery store as a teenager, but their paths had never crossed. Munger had left for the California sun, building a successful law practice, but the intellectual gravity of his hometown friends kept pulling him back. When they finally met, the connection was electric. It was, as Buffett would later describe, like finding an intellectual twin. They didn't just talk, they sparred, they debated, they dissected ideas with a shared, obsessive joy. Here was someone who could not only keep up with Buffett's lightning-fast mind, but could challenge it, reframe it, and send it in entirely new directions. Buffett was obsessed with the what is a business worth? Munger was obsessed with the why. Why is this a good business in the first place? Why does it have a durable competitive advantage? Why will it be better in 10 years than it is today? This was a fundamental difference in their investment mindset, a schism that would, paradoxically, become the source of their greatest strength. Buffett, the Grahamite, was looking for a fair company at a wonderful price. Munger, the pragmatist, was beginning to formulate the idea that it was far better to buy a wonderful company at a fair price. This initial meeting wasn't just a pleasant social occasion, it was the forging of an intellectual alliance that would compound knowledge and capital for the next 60 years. Buffett recognized Munger's unique mind almost immediately. He saw not an adversary but a necessary collaborator. He began calling Munger from Omaha constantly, running ideas by him, big and small. He wasn't looking for validation, he was looking for holes. He was stress-testing his own thinking against one of the sharpest, most cynical, and most rational minds he had ever encountered. In one of their earliest and most pivotal conversations, Buffett pleaded with Munger to give up law. Law is a fine profession, Buffett argued, but you can do better. You can apply that immense intellect to managing capital, and you can do it for yourself. He was essentially recruiting his own chief critic, paying him to be a professional skeptic of his own ideas. It took some convincing, but Munger eventually wound down his law practice and started his own investment partnership in 1962. For years, they operated in parallel universes, Buffett in Omaha, Munger in Los Angeles. But they were in constant communication. They were building a shared mental library, a database of business models, case studies, and human follies that they could draw upon. Their decision-making was becoming a dialectical process. Buffett would propose a thesis, an investment in a struggling department store, or a discounted textile mill. Munger would respond with the antithesis, a barrage of questions about the long-term prospects, the management quality, the industry headwinds. Out of that clash, a synthesis would emerge, a more refined, more robust, and far less error-prone investment decision. This wasn't groupthink. It was the opposite. It was a purpose-built system for intellectual combat, designed to kill bad ideas before they could kill a portfolio. The CEO mindset that Buffett was cultivating wasn't that of a solitary genius, but of a systems builder who understood that the most important part of the system was the one that told him he was wrong. The underlying psychological principle at play here is the deliberate embrace of what is known as constructive conflict, a powerful antidote to the venomous cognitive bias of groupthink. Groupthink, a term coined by psychologist Irving Janis, describes a phenomenon where a group of individuals reaches a consensus without critical evaluation of alternative viewpoints, driven by a desire for conformity and harmony. In an investment club or among a circle of friends, this manifests as a dangerous spiral of mutual reinforcement. An idea is proposed. Because everyone in the group shares a similar background, risk tolerance, and information source, they quickly find reasons to agree. Dissenting thoughts are subtly suppressed, either by the individual who doesn't want to rock the boat or by the group's social pressure. The initial idea, which may have been flawed, is not challenged but celebrated. Confidence builds not on the merit of the thesis, but on the strength of the social agreement. This is the path to ruin. It's how people get swept up in bubbles, from dot-com mania to cryptocurrency frenzies. The feeling of being right becomes more important than actually being right. Buffett and Munger's partnership was a system designed to short-circuit this process. It was a real-world application of the dialectical method, a form of discourse tracing back to Socrates. It involves a thesis, an initial proposition, an antithesis, a counter-proposition, and a synthesis, a new, more truthful proposition that resolves the conflict between the two. Buffett would put forth the thesis, "This company is cheap." Munger would deliver the antithesis, It's cheap for a reason. The industry is dying. The management is mediocre, and its competitive position is eroding. The synthesis that emerged wasn't always "don't buy." Sometimes it was "you're right, let's pass." Other times it might be "the price is so low that it accounts for those risks, let's make a small bet." And, most powerfully, it would eventually become "you're right, cheapness isn't enough. We need to find great businesses, even if we have to pay more for them." This process actively forces the participants to confront opposing views. It immunizes them against the most seductive bias of all, confirmation bias, our natural tendency to seek out and favor information that confirms our pre-existing beliefs. Munger was Buffett's walking, talking confirmation bias filter. His job was to present the disconfirming evidence, to argue the case for the prosecution against Buffett's investment ideas. By building this into their process, they weren't just making better decisions. They were engaging in a constant process of mental training, sharpening their critical thinking skills with every debate. This is behavioral finance in action, not as an academic theory but as a lived, daily practice. They understood, perhaps intuitively at first and then explicitly, that the human brain is a flawed instrument for making financial decisions. It is wired for survival in the savannah, not for navigating the complexities of the stock market. It seeks consensus, because in our evolutionary past, being ostracized from the tribe meant death. But in investing, the consensus is almost always wrong. The greatest profits are found in the lonely, uncomfortable space of contrarianism. Their partnership was a machine for creating productive discomfort, for forcing them to inhabit that lonely space and to test if their contrarian idea was genius or just insanity. So how do you translate this legendary partnership into a practical blueprint for your own life? How do you build your own Munger? This mental model can be called building your personal devil's advocate, a systematic process for stress testing your most important decisions, be they in investing, business, or life. It requires discipline and, most importantly, humility. Step 1 is identification and recruitment. You are not looking for a cheerleader, you are looking for a sparring partner. This person does not need to be an investment professional, but they must possess certain traits. First, they must be genuinely intelligent and capable of independent thought. They cannot be someone who just parrots headlines or popular opinion. Second, they must be constitutionally skeptical. They should be the kind of person who naturally asks why and looks for the flaw in an argument. Third, and this is crucial, you must respect their intellect, even when you disagree with them. If you dismiss their arguments out of hand because they don't have a finance degree, the system fails. Their value is often in their different perspective. The engineer who sees system flaws, the lawyer who sees contractual risk, the marketer who sees a weak brand. Finally, they must be someone you trust to be honest, even when it's uncomfortable. This can't be someone who is afraid of offending you. Your pitch to them is simple. I am about to make a significant financial decision, and I am likely suffering from confirmation bias. My goal is not to convince you that I'm right. My goal is for you to try your absolute hardest to convince me that I am wrong. Your job is to be the devil's advocate. Tear this idea apart. Step 2 is formalizing the process. Do not do this casually over a beer. Treat it like a serious executive decision-making process. Prepare a one-page document outlining your investment thesis. It should include the company, the price you plan to pay, a clear and concise explanation of why you believe it's a good investment, the story, and the 3 to 5 key data points or assumptions that your entire thesis rests on. Send this to your Munger ahead of time and schedule a specific time to discuss it. This formal structure signals the seriousness of the exercise and forces you to clarify your own thinking. Step 3 is the execution of the debate. During the conversation, your role is not to defend your ego. Your role is to listen and to learn. Adopt the mindset of a scientist trying to falsify their own hypothesis. Do not counter their arguments with yes, but. Instead, use phrases like, "That's a good point. How would I mitigate that risk?" Or, "I hadn't considered that. What evidence would prove you right?" Actively seek out the disconfirming evidence. Your monger's job is to attack the key assumptions you listed. If you assume revenue growth will continue at 15%, they should be asking what could make it slow to 5%. If you assume the company has a strong moat, they should be listing the competitors who could breach it. The goal is not to win the argument. The goal is to discover the truth. After the conversation, you must commit to writing down the 3 strongest arguments against your investment. Then, you must sit with them. This forces you to internalize the counterargument and prevents you from immediately reverting to your original, biased position. Only after you have honestly grappled with the strongest points of the opposition can you make a truly informed decision. This structured process for critical thinking is what separates amateur speculators from professional capital allocators. To truly appreciate the power of this model, we must examine its antithesis, the path of the 99%, the dangerous comfort of the sycophant circle. This is the default setting for most investors. They talk about stocks with friends who are at a similar level of financial education, who read the same websites, and who get excited by the same trends. The conversation isn't a debate, it's a hype session. Consider the story of the dot-com bubble in the late 1990s. Millions of ordinary people, caught up in the mania, formed informal investment clubs, or simply took cues from their neighbors and colleagues. The prevailing wisdom was that old metrics like earnings and book value didn't matter anymore. It was a new paradigm. In these circles, buying a company like Pets.com wasn't a thesis to be challenged. It was a foregone conclusion. If you were the one person in the room to ask, but how will they ever make a profit? You weren't seen as a prudent risk manager. You were seen as a dinosaur who didn't get it. The social pressure to conform was immense. The stories were intoxicating. Teachers, dentists, and plumbers were becoming millionaires overnight by buying anything with a .com in its name. The sycophant circle created a feedback loop of irrationality. Each person's anecdotal success, which was really just luck in a rising tide, was presented as proof of genius, encouraging the others to take even greater risks. The catastrophic consequences are now a matter of historical record. When the bubble burst in 2000, trillions of dollars in paper wealth evaporated. People lost their life savings, their retirement funds, and their homes. They weren't undone by a single bad stock pick. They were undone by a flawed decision-making process, a process that actively rejected dissent and embraced the warm, reassuring, and ultimately fatal glow of groupthink. This isn't just a historical anecdote, it's a recurring pattern. It happened with the housing bubble in 2007, with cannabis stocks in 2018, and with countless individual meme stocks. The technology changes, but the psychology remains the same. The 99% surround themselves with mirrors, while the 1% surround themselves with microscopes and sledgehammers. The financial connection between building an intellectual alliance and building wealth is not abstract, it is direct, tangible, and manifests powerfully on the balance sheet of a company like Berkshire Hathaway. In the early days, Buffett's partnerships were almost exclusively focused on the Graham-style cigar butt investing. He was buying tangible assets for less than they were worth. This is a mathematically sound strategy, but it has a severe limitation. It doesn't scale well. There are only so many deeply undervalued, mediocre companies you can buy. More importantly, it requires you to constantly be finding new ideas, because a cigar butt, by its nature, is a one-time puff. You sell it once the market recognizes its value, and then you have to find another. Munger's influence fundamentally altered Buffett's approach to capital allocation. The constant questioning, the focus on why instead of just what, pushed Buffett away from buying cheap businesses and toward buying great businesses. This shift had a monumental impact on Berkshire's long-term performance. Consider the contrast. A cigar butt investment might involve buying a company trading at a 50% discount to its liquidation value. You might buy it for $10 million, and if all goes well, you sell it a year or two later for $15 million. That's a fantastic 50% return. You've made $5 million, but now that $15 million in capital needs a new home. the process starts all over again. A Munger-influenced investment, on the other hand, might involve buying a wonderful business with a durable competitive advantage for a fair price of, say, $100 million. This business isn't a liquidating asset, it's a compounding machine. It grows its earnings at 15% per year. After a decade, that company might be earning 3 times what it was when you bought it, and its value could be $400 million or more. You haven't had to do anything. You haven't incurred transaction costs or taxes by selling. The capital is allocating itself through the genius of the business model you purchased. The shift from the former strategy to the latter is the primary reason Berkshire Hathaway is a trillion-dollar company, and not just a fondly remembered defunct investment partnership. This philosophical change, born directly from the intellectual friction between Buffett and Munger, is arguably the single most important financial decision in the company's history. It transformed Berkshire from a collector of disposable assets into a permanent owner of compounding machines. The direct financial connection is the difference between linear transactional returns and exponential long-term wealth creation. Having a Munger in your corner doesn't just prevent you from making a bad decision. It can fundamentally upgrade the quality and scalability of your entire financial strategy, leading to a level of wealth management and financial freedom that is simply unattainable within an intellectual echo chamber. The year is 1972. Warren Buffett, now at the helm of a sprawling conglomerate built from the husk of a failing textile mill called Berkshire Hathaway, is presented with an opportunity. A family-owned candy company based in California is for sale. Its name is See's Candies. By every metric that Buffett has been trained to value, the asking price is outrageous. The family wants $30 million for a business with tangible assets, buildings, equipment, inventory, worth only about $8 million. The remaining $22 million is for something intangible, something the accountants called goodwill. To the hardcore disciple of Ben Graham, goodwill was a dirty word. It was speculative fluff, a phantom asset that could evaporate overnight. Buffett's quantitative mind saw a business being offered for nearly 4 times its book value. His instinct, honed by years of dumpster diving for cigar butts, was to walk away. The price was simply too high. He made a counteroffer of $25 million, and it was rejected. For Buffett, that should have been the end of it. But it wasn't. Because Charlie Munger was in his ear. Munger had seen something different in See's Candies. He had seen beyond the numbers on the balance sheet. He had tasted the candy. He had seen the long lines of devoted customers at their stores, happily paying a premium price for a box of chocolates. He saw a brand that was practically a religion in California. He saw a powerful moat, an invisible barrier that protected the business from competition. Customers didn't just buy See's for the taste. They bought it for the nostalgia, the tradition, the feeling of giving a high-quality gift. This was a psychological asset, not a physical one, and Munger understood that it was immensely valuable. He argued forcefully with Buffett. "Warren," he would say, "you're thinking about this all wrong. You're looking at it as a Grahamite, looking at the liquidation value. But this is a business you're never going to liquidate. This is a business that's going to gush cash for decades. Don't you see the pricing power? They can raise their prices every year and customers will still line up. This isn't a cigar butt, this is a gold mine." Munger was forcing Buffett to confront the limitations of his own wildly successful model. He was challenging the very foundation of his partner's investment mindset. He was making the case that sometimes it's worth paying a premium for exceptional quality. It was a battle between the quantitative and the qualitative, between the past and the future. Buffett, to his immense credit, listened. He didn't just hear Munger. He allowed his partner's logic to fundamentally alter his own. It was an act of profound intellectual humility. He overrode his own deeply ingrained instincts and agreed to pay the family's asking price of $30 million, a price that made his stomach churn. That decision, born directly from Munger's relentless qualitative challenge, would change everything. See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all without requiring significant additional capital investment. It was, as Buffett would later call it, the prototype of a dream business, but its true value wasn't the $2 billion. Its true value was the lesson it taught Buffett. See's Candies was the intellectual bridge that carried him from the world of buying cheap businesses to the world of buying great businesses. It recalibrated his brain, proving that the intangible asset of a powerful brand could be more valuable than all the tangible assets combined. This epiphany, forced upon him by his intellectual sparring partner, would directly lead to Berkshire's legendary investments in companies like Coca-Cola, American Express, and Apple. The See's Candies deal wasn't just a transaction. It was a paradigm shift, a testament to the power of having someone in your life who can see the value you're blind to and has the courage to tell you you're wrong. The deep psychological principle that Munger forced Buffett to overcome is one of the most powerful and pervasive cognitive biases, anchoring bias. Anchoring is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. For Buffett, his anchor was the entire intellectual framework of Ben Graham's security analysis. He was anchored to the concept of book value, to the idea that the primary source of a margin of safety came from buying assets for less than they were worth. When he saw See's Candies, asking price of $30 million against a book value of $8 million, his brain immediately anchored to that discrepancy. The price felt fundamentally wrong based on his established mental map. This is an incredibly difficult bias to overcome because it feels rational. It's based on a system that has worked in the past. Your brain tells you, this is the rule. The rule has made me successful, therefore the rule must not be broken. Munger's role was to provide a powerful new anchor. He didn't just say pay the price. He reframed the entire problem. He was implicitly arguing, your anchor is wrong. You are anchoring to the balance sheet of the past. I want you to anchor to the cash flow of the future. He shifted the focus from static assets to dynamic earning power. He introduced qualitative factors like brand loyalty, pricing power, and customer psychology as legitimate, powerful anchors for valuation. This is a classic example of what is known as second-level thinking. First-level thinking is simplistic and superficial. It says the asking price is high compared to the book value, so it's expensive. Second-level thinking is deep, complex, and nuanced. It says, yes, the price is high relative to book value. But why? It's because the book value fails to capture the enormous economic value of the brand. This brand allows the company to raise prices consistently without losing customers, which will generate massive, predictable cash flows for years to come. Therefore, when viewed through the lens of future earnings, it's actually cheap. By relentlessly hammering this second-level perspective, Munger helped Buffett lift the old anchor and set a new, more effective one. Overcoming anchoring bias requires either a profound act of self-awareness or an external force that shatters your frame of reference. Munger was Buffett's external force. He understood that a great business is an engine of wealth creation, and sometimes you have to pay the sticker price for a superior engine. This shift from a purely quantitative to a qualitative plus quantitative approach is a hallmark of sophisticated portfolio management and a crucial step in achieving mastery over the behavioral finance demons that plague most investors. How can you apply this powerful lesson to your own stock analysis? You can create a mental model I call the quality over price litmus test. This is a structured checklist of questions designed to force you out of the first-level thinking trap of anchoring on price and into the second-level thinking world of assessing business quality. Before you dismiss a stock as too expensive based on its P/E ratio or price-to-book value, you must subject it to this test. There are 5 key questions. Question 1. The pricing power test. Ask yourself, if this company raised the price of its core product or service by 10% tomorrow, would its customers revolt and flee to a competitor, or would they grumble and pay it? A company that can consistently raise prices without losing business possesses an immense competitive advantage. Think of Apple's iPhones, a premium coffee chain, or indeed, C's candies. This is the single most important sign of a great business. If the answer is a resounding yes, the high sticker price might be justified. Question 2. The toll bridge test. Does this company own a metaphorical toll bridge? Is it an essential part of a larger system that is difficult or impossible for customers to bypass? This could be a dominant operating system like Microsoft Windows, a crucial payment network like Visa or MasterCard, or a railroad with an exclusive route. A business that owns an indispensable piece of infrastructure for its industry has a powerful, durable moat that metrics like book value will never capture. Question 3. The idiot-proof test. Buffett famously said, "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later, one will." Ask yourself, is the business model so strong, the brand so beloved, and the competitive position so entrenched that it can survive a period of mediocre management? That truly great business has a structural advantage that is bigger than any single executive. This is a brutal but effective filter for quality. Question 4. The reinvestment runway test. A great business not only gushes cash, but it also has intelligent opportunities to reinvest that cash at high rates of return. Ask, does this company have a long runway for growth? Can it open more stores, expand into new countries, or develop new product lines that will generate returns as good as or better than its current business? A company that has run out of places to profitably deploy its capital will eventually become a stagnant investment, no matter how great its current operations are. Question 5. The unquantifiable asset test. What is the single most valuable asset this company has that does not appear on its balance sheet? For C's, it was the brand and customer loyalty. For a pharmaceutical company, it might be its patent portfolio or its R&D culture. For a technology company, it might be its network effect. Force yourself to identify and articulate the value of this intangible goodwill. If you can't find a powerful, unquantifiable asset, you are likely looking at a commodity business, and in that case, price is all that matters. By systematically running every potential investment through this 5-part litmus test, you force yourself to adopt a Munger-like perspective. You are deliberately creating a process to challenge your own anchoring bias. It transforms your decision-making from a simple price comparison to a deep, qualitative investigation into the sources of durable business value. This is the CEO mindset applied to stock picking. Let's examine the antithesis, the well-trodden path of the value trap collector. This is the investor who has learned just enough of Ben Graham's principles to be dangerous. They are obsessed with finding statistical bargains. They run stock screeners for low price-to-earnings ratios, low price-to-book ratios, and high dividend yields. Their portfolio becomes a museum of mediocrity, filled with companies that are cheap for very good reasons. They buy a struggling retailer because it's trading below its inventory value, ignoring the fact that the inventory is out of fashion and will have to be sold at a steep discount. They buy a newspaper company because its PE ratio is 5, ignoring the structural decline of print advertising that will erode its earnings year after year. They buy a regional bank because it has a high dividend yield, ignoring its risky loan book that could blow up in the next recession. The value trap collector is a first-level thinker. They see cheap and they buy. They mistake a low price for a good value. They fall in love with the feeling of getting a deal, but they fail to realize they are buying a melting ice cube. The business is deteriorating, its competitive position is weak, and its future prospects are bleak. They might get a small, one-time pop if the market sentiment shifts slightly, but they will never experience the explosive, life-changing returns that come from owning a truly great, compounding business over a decade or more. The value trap collector's portfolio is a testament to the danger of ignoring Munger's wisdom. It is a collection of cigar butts that, more often than not, turn out to be soggy, unsmokable duds. Their fatal flaw is their failure to ask the most important question: is this a business I would be happy to own for 10 years if the stock market shut down tomorrow? For most of their holdings, the honest answer would be a terrified no. The direct financial connection between paying up for quality and long-term wealth creation is one of the most powerful forces in finance, the magic of compounding. Let's quantify the See's Candies lesson. When Berkshire bought See's for $30 million, it was earning about $4 million pre-tax. So they paid a multiple of about 7.5 times earnings, which was high for Buffett at the time. A typical cigar butt investment might have been purchased at 3 times earnings. Now let's trace the financial impact. Because of its brand and pricing power, See's didn't need to retain its earnings to grow. It could send almost all of its profits up to Berkshire headquarters in Omaha every year. That annual gusher of cash, which grew from a few million to over $80 million per year, became the seed capital for other investments. The profits from selling chocolates in California were used to buy shares of Coca-Cola, The Washington Post, and American Express. The initial $30 million investment was not just a standalone success. It became a financing engine for the entire Berkshire empire. On a portfolio management level, this principle transforms your entire approach. Instead of a high-turnover strategy of buying and selling mediocre companies, you adopt a low-turnover, long-term holding strategy for exceptional ones. This dramatically reduces transaction costs and, more importantly, defers capital gains taxes for years or even decades, allowing your investments to compound on a pre-tax basis, a massive, often overlooked advantage. Imagine 2 investors, each starting with $100,000. Investor A is a value trap collector. He buys cheap stocks, and when they appreciate by 30%, he sells, pays his taxes, and looks for the next cigar butt. His returns are lumpy and transactional. Investor B learns the Munger lesson. She buys a wonderful company for a fair price and holds it for 10 years as it grows earnings at 15% per year. She incurs no transaction costs and pays no capital gains taxes along the way. At the end of the decade, her initial investment is likely worth over $400,000. Investor A, meanwhile, is still hunting for bargains, likely having experienced a few big winners but also several value traps that went to zero, with his progress constantly eroded by taxes and trading fees. The financial transformation is clear. Embracing the principle of quality over price is the switch that flips your portfolio from a mode of speculation to a mode of true, long-term wealth compounding. It is the lesson that separates the amateurs from the masters of capital allocation. The date is August 29, 1991. The phone rings in Warren Buffett's office. On the line is the U.S. Secretary of the Treasury, Nicholas Brady. The news is catastrophic. Salomon Brothers, the legendary Wall Street investment bank in which Berkshire Hathaway was the largest shareholder, was on the brink of collapse. The firm had been caught in a massive scandal, repeatedly submitting illegal bids in U.S. Treasury auctions to corner the market. The Treasury had barred Salomon from bidding for government securities, a move that was effectively a death sentence. Without the ability to participate in these auctions, Salomon's clients would flee, its funding would dry up, and the firm would implode within days, potentially taking a huge chunk of the global financial system with it. For Buffett, this was more than a financial crisis. It was a personal nightmare. He had invested $700 million of Berkshire's money in Salomon preferred stock just a few years earlier. Now that entire investment was at risk of being wiped out, but far more was at stake than just money. The reputation of Berkshire Hathaway, and Buffett's own personal reputation for unimpeachable integrity, was now tied to a firm at the center of one of the biggest scandals in Wall Street history. The pressure was immense, regulators were circling, the media was in a frenzy, and the market was panicking. In this crucible of chaos, Buffett made a decision that would define his career. He flew to New York, took over as interim chairman of Salomon, and prepared to face Congress. His mission was not just to save the firm, but to restore its integrity. Throughout this terrifying period, his most important counsel was not from lawyers or bankers, but from the unwavering moral compass of Charlie Munger. Munger wasn't in the trenches in New York, but he was in constant contact, a voice of absolute clarity and principle on the other end of the phone. While others might have been focused on damage control, legal maneuvering, or finding a way to salvage some financial value, Munger's advice was brutally simple and consistent. Be completely transparent, cooperate fully with investigators, and cut out the cancer immediately, no matter the short-term cost. He reinforced Buffett's own instincts that reputation was the single most valuable asset they had, and it could not be compromised. There was one now famous exchange that perfectly encapsulates their dynamic. Buffett, preparing for his testimony before a congressional subcommittee, was agonizing over how to handle the situation. Munger's advice was blunt. "Warren, if you lose money for the firm, I will be understanding. If you lose a shred of reputation for the firm, I will be ruthless." This was not a comforting platitude. It was a direct order. It was the ultimate litmus test for every decision Buffett would have to make in the coming weeks. It provided an unshakable framework for navigating an impossibly complex crisis. Armed with this clarity, Buffett's testimony to Congress was a masterclass in accountability. He did not deflect or excuse. He stated plainly, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." He promised to root out the wrongdoers and implement a new culture of compliance. His honesty and decisive action saved Solomon from immediate failure and, more importantly, preserved the pristine reputation of Berkshire Hathaway. The crisis was a trial by fire, not just for Buffett's leadership, but for the core values of their partnership. It proved that their alliance was built on something far deeper than just a shared genius for capital allocation. It was built on an absolute, non-negotiable commitment to integrity, a principle that Munger championed with fierce, unwavering resolve. The psychological principle that Munger's guidance helped Buffett navigate is a powerful duo of cognitive biases: the commitment and consistency bias, often compounded by the trap of social proof. The commitment and consistency bias describes our deep psychological need to be consistent with our prior acts and statements. Once we've made a decision or taken a stand, we face personal and interpersonal pressure to behave consistently with that commitment. In the Solomon crisis, Buffett had committed $700 million to the firm and publicly endorsed its management. The natural, subconscious tendency would be to defend that prior decision, to downplay the severity of the scandal, to find ways to rationalize the behavior of the executives he had trusted. It's a form of ego defense. Admitting the full scope of the problem would be tantamount to admitting, "I made a terrible mistake in judgment." This is where many leaders falter. They become trapped by their past commitments and try to manage the public relations aspect of a problem rather than solving the problem itself. This bias is then amplified by social proof, our tendency to look to others to determine the appropriate way to behave in a given situation, especially during times of uncertainty. On Wall Street in the 1990s, the prevailing social proof was a culture of aggressive ends justify the means behavior. The line between clever arbitrage and illegal market manipulation was often blurry, and the culture encouraged pushing that line as far as possible. In the midst of the scandal, many within Solomon and the broader Wall Street community would have been advising a path of legal stonewalling, of minimizing admissions, and of protecting their own. The standard procedure in such a crisis was to lawyer up and shut up. Munger's advice was a powerful antidote to both of these biases. His ruthless focus on reputation provided a new, stronger commitment that overrode the old one. The commitment was no longer to the past decision of investing in Solomon, but to the timeless principle of integrity. This gave Buffett the psychological freedom to act decisively, without being shackled to his prior judgment. Munger's counsel also shattered the dangerous social proof of Wall Street. He was an external, authoritative voice from outside the bubble, reminding Buffett that the rules of Omaha, of honesty, transparency, and reputation, were the only ones that mattered in the long run. He was essentially saying, "Do not follow the crowd is wrong, adhere to our first principles." This ability to provide a clear, principled framework during a moment of extreme chaos and uncertainty is a crucial function of a true intellectual partner. They don't just challenge your investment theses, they challenge your ethical rationalizations and keep you anchored to your core values when the pressure to compromise is at its highest. This is a vital component of long-term risk management. From this harrowing episode, we can distill a powerful mental model for any leader or entrepreneur: the reputational moat framework. Your company's reputation is just as important as its competitive moat, and it must be protected with the same ferocity. This framework is a simple, three-step process for making decisions under pressure. Step 1. Apply the front page test. Before making any significant decision, particularly one in a gray area, imagine that your actions will be reported in detail on the front page of the most respected newspaper in the country tomorrow, written by a smart but unfriendly reporter. Would you be comfortable with the story? Would you be proud to have your family, your employees, and your customers read it? If you feel a knot in your stomach, if you start thinking about how you would spin the story, then you are on the wrong track. This simple thought experiment cuts through complex rationalizations and forces you to view your actions through the lens of public perception and long-term consequences. Step 2. Identify the ruthless principle. Just as Munger provided Buffett with the ruthless principle of reputation, you must identify the single, non-negotiable value that will guide your decision. In a crisis, you will be pulled in a dozen different directions: financial preservation, legal liability, employee morale, customer retention. You must choose one principle that will serve as your North Star. For a company built on trust, like a financial institution, it must be integrity. For a company built on safety, like an airline, it must be transparency about any failures. This ruthless principle acts as a tiebreaker for all other competing priorities. It simplifies the complex by providing a clear hierarchy of values. Step 3. Execute the surgical cut. Once you've identified the problem, your response must be swift, decisive, and complete. Don't trim the hedges. Pull the weed out by the root. In Solomon's case, this meant firing the responsible parties immediately, cooperating fully with investigators, and installing a new, rigorous compliance system. The temptation in a crisis is often to take incremental, cautious steps to see how things play out. This is almost always a mistake. A slow, hesitant response signals weakness and allows the narrative to be controlled by others. A surgical cut, while painful in the short term, demonstrates leadership, takes control of the situation, and is the fastest path to rebuilding trust. This framework, front page test, ruthless principle, surgical cut, is a repeatable process for navigating the inevitable crises that every business and every investor will face. It's a system for protecting your most valuable and most fragile asset. The antithesis of this approach is the short-term profit maximizer, the leader or investor who consistently sacrifices long-term reputation for immediate gain. History is littered with the corpses of companies that followed this path. Think of Enron in the early 2000s. Its executives, obsessed with meeting quarterly earnings estimates and boosting the stock price, created a culture of systemic accounting fraud. They used off-balance sheet entities to hide debt and inflate profits. In the short term, they were heroes. The stock soared, and they were celebrated as innovators. But they were hollowing out the company from the inside. They failed the front page test at every turn, operating in a world of secrecy and deception. Their ruthless principle was not integrity. It was make the numbers no matter what. When the scandal was finally exposed, the collapse was swift and total. The company went bankrupt, its stock became worthless, and its name became a synonym for corporate fraud. The executives went to prison. They had maximized short-term profits and, in the process, completely destroyed their long-term reputational moat, leading to a 100% loss for shareholders. The same pattern can be seen with Wells Fargo and its fake accounts scandal, or Volkswagen and its emissions cheating scandal. In every case, a focus on short-term metrics led to unethical behavior that ultimately caused catastrophic, long-term financial and reputational damage. The short-term profit maximizer sees reputation as a soft asset, a nice-to-have. The Munger-Buffett model understands that reputation is the bedrock upon which all financial value is ultimately built. Without it, everything else is just a house of cards waiting for a gust of wind. The direct financial connection between integrity and the balance sheet, while sometimes hard to quantify, is immense. For Berkshire Hathaway, its reputation is arguably its most valuable asset. How does this manifest in real dollars? First, it creates unparalleled deal flow. When a family-owned business is looking to sell, they often call Berkshire first. They know that Buffett will be a fair negotiator, will close the deal quickly without playing games, and most importantly, will be a permanent, responsible steward of the business they spent their lives building. They are often willing to accept a lower price from Berkshire than they would from a private equity firm, which has a reputation for stripping assets and firing employees. This reputation discount has saved Berkshire hundreds of millions, if not billions of dollars on acquisitions over the decades. Second, its reputation was the key to its role as a lender of last resort during the 2008 financial crisis. When companies like Goldman Sachs and Bank of America were on the brink, they turned to Buffett. His investment was not just a capital infusion, it was a stamp of approval, a signal to the panicked market that these institutions were sound. In return for lending his reputation, Buffett was able to negotiate incredibly favorable terms, high-yield preferred stock plus warrants, that resulted in over $10 billion in profits for Berkshire shareholders. This opportunity was available to Stockley because of the decades of trust and integrity he and Munger had built. Finally, a strong reputation translates into a lower cost of capital and better relationships with regulators, customers, and employees. It is a form of risk management that inoculates the company against the kind of existential threats that destroyed Salomon Brothers before Buffett's intervention. In an executive decision-making context, this means that prioritizing ethics is not just a moral choice, it is a financially superior strategy. The intangible asset of trust might not be listed on the balance sheet, but it generates very tangible returns, year after year. The Salomon crisis was the ultimate proof that Munger's ruthless insistence on reputation was not just good ethics, it was brilliant business. It was the mid-2000s, and the world was changing. Technology was no longer a niche sector, but the driving force of the global economy. Yet, for Warren Buffett, it remained a foreign country. His famous circle of competence was firmly drawn around businesses he could understand: insurance, banking, consumer goods. He famously quipped that he didn't invest in technology because he didn't know how to tell the difference between the winner and the losers. He couldn't predict what a tech company would look like in 10 years, a key criterion for his long-term investment mindset. This principle had served him well, helping him avoid the dot-com bust. But as the new century wore on, it was also causing him to miss out on some of the biggest wealth creation stories in history. This is where Charlie Munger once again played a pivotal role, not by challenging a specific investment idea, but by challenging the very boundaries of Buffett's self-imposed limitations. The story of the investment in BYD, a relatively unknown Chinese battery and electric car manufacturer, is a perfect illustration. The idea didn't come from Buffett or even Munger. It came from David Sokol, a top executive at Berkshire's Mid-American Energy subsidiary. In 2008, Sokol brought a proposal to invest in BYD to Munger. Munger was intrigued. He wasn't a technology expert either, but his mental model was different. He didn't just look at the business, he focused intensely on the person running it. The founder and CEO of BYD, Wang Chuanfu, was a brilliant chemist and a relentless entrepreneur, a combination that Munger found irresistible. He saw in Wang a modern-day Thomas Edison or Jack Welch, a fanatical, hands-on leader who was both a technical genius and a savvy business operator. Munger famously told Buffett, "This guy is a combination of Thomas Edison and Jack Welch. He's like nothing I've ever seen before. You've never met anyone like him." Buffett was deeply skeptical. The company was in China, a market he had little experience with. It was in the highly complex and competitive battery and auto industries, sectors far outside his circle of competence. His initial reaction was a firm no, but Munger was persistent. He didn't argue the technical merits of BYD's battery technology, he argued the human merits of Wang Chuanfu. He was making a bet on the jockey, not just the horse. He kept pushing, urging Buffett to reconsider. He sent Buffett reports and analysis, but his core argument was always about the quality and drive of the founder. It was a classic Munger approach. Find a brilliant person running a good business with a huge tailwind and bet big. This gentle but relentless pressure from his trusted partner eventually wore Buffett down. In a rare move, Buffett deferred to Munger's judgment, overriding his own deep-seated reluctance. Berkshire Hathaway invested approximately $232 million to acquire a 10% stake in BYD in September 2008. The financial world barely noticed. It was a relatively small investment for Berkshire, and it seemed utterly out of character. But it was a landmark decision. It was Buffett, the master of his domain, admitting that his partner saw something he didn't, and trusting that vision enough to venture far outside his comfort zone. That act of intellectual humility would be rewarded spectacularly. By 2021, Berkshire's initial $232 million stake was worth over $7 billion, a return of more than 30 times their initial investment. The BYD investment was a testament to the power of a partnership that doesn't just refine ideas, but actively works to expand the intellectual boundaries of its members, pushing them to evolve and adapt to a changing world. The psychological barrier that Munger helped Buffett overcome in the BYD deal is a powerful one known as familiarity bias, which is a close cousin of the curse of knowledge. Familiarity bias is our natural tendency to prefer what is familiar and to be skeptical of what is new or foreign. Investors exhibit this by over-investing in their home country's stock market, home country bias, or in industries they already know, even if better opportunities exist elsewhere. For Buffett, his familiarity was with American consumer brands and financial institutions. Investing in a Chinese technology company was the psychological equivalent of stepping onto another planet. His brain, like all human brains, was wired to see this unfamiliarity as risk. The curse of knowledge is a cognitive bias that occurs when an individual, communicating with other individuals, unknowingly assumes that the others have the background to understand. For experts like Buffett, this can manifest inwardly. His deep expertise in his own circle of competence could, paradoxically, make it harder for him to appreciate the potential of a business operating under a completely different set of rules. His knowledge of how the American auto industry worked, for example, might have been a hindrance, not a help, in evaluating a disruptive Chinese electric vehicle company. Munger's genius was in circumventing these biases. He didn't try to make Buffett a battery expert. He didn't present a 100-page deck on lithium-ion chemistry. That would have been a direct assault on Buffett's circle of competence and likely would have failed. Instead, he used a framework that Buffett understood perfectly: betting on extraordinary management. By framing the investment as a bet on a person, Wang Chuanfu, Munger was translating the unfamiliar into the familiar. Buffett might not have understood the technology, but he was the world's foremost expert on identifying exceptional CEOs. Munger found a backdoor into Buffett's psychology. He built a bridge from his own insight to Buffett's existing mental models. This is a masterful technique for influencing intelligent and often stubborn people. You don't tell them they're wrong. You show them how a new idea is consistent with their own deepest principles, just applied in a new context. Munger was essentially saying, Warren, this isn't a tech investment. This is a great manager investment, the same kind we've always made. He just happens to be in China, and he happens to make batteries. This reframing allowed Buffett to overcome his familiarity bias without having to abandon his core philosophy. It was a demonstration of not just intellectual partnership, but of deep emotional intelligence and persuasive skill. This leads us to a crucial mental model for any investor or entrepreneur who wants to stay relevant: the Circle of Competence Expansion Protocol. Your circle of competence is your greatest asset, but it can also become your prison if you don't actively work to expand it. The protocol is a deliberate, four-step process for learning and growing without taking foolish risks. Step 1. Acknowledge the boundary. The first and most important step is to be brutally honest with yourself about what you know and what you don't know. Like Buffett, you must clearly define the edges of your circle. Write it down. For example, I understand consumer staple businesses and enterprise software, but I do not understand biotechnology or energy exploration. This active definition is a powerful defense against straying into areas where you are at a disadvantage. Step 2. Find a Sherpa. A Sherpa is a trusted guide who can lead you into new territory. When you want to expand your circle, you don't just start reading random articles. You find an expert you trust, your own personal monger for that specific domain. This could be a friend who is a software engineer, a mentor who understands real estate, or even a handful of writers or analysts whose work you have followed and found to be consistently rational and insightful. Your Sherpa's job isn't to give you stock tips, but to teach you the fundamental principles of the new domain, the key metrics, the competitive landscape, the unique risks and opportunities. Step 3. Build a learning ladder. You don't climb Mount Everest in a single day. You expand your circle of competence incrementally. Start with the easiest to understand businesses on the periphery of your current circle. If you understand retail, maybe your next step is to study payment processing companies. If you understand software, maybe you start learning about cybersecurity. Create a curriculum for yourself. Read the annual reports of the top 3 companies in the news sector. Listen to their conference calls. Identify the key questions you can't answer and ask your Sherpa. This is the core of financial education, a self-directed, disciplined process of filling in your knowledge gaps. Step 4. Make scout investments. Once you've done the work and feel you have a basic grasp of the new domain, you don't bet the farm. You make a small scout investment. This is a position small enough that it won't hurt your portfolio if it goes to zero. The purpose of this investment is not primarily to make money. It's to force you to pay closer attention. When you have real money on the line, even a small amount, you will follow the company and the industry with a focus and intensity that passive reading can never replicate. This is how you gain real-world experience and slowly, carefully expand the boundaries of your circle. The BYD investment was, in a way, a scout investment for Berkshire, a way to learn about a new geography and a new industry with a trusted guide. The antithesis to this disciplined approach is the stagnant expert. This is the individual who becomes a prisoner of their own past success. They had a big win in a particular industry or with a particular strategy, and they spend the rest of their career trying to replicate it. Think of the value investor who, after the dot-com bust, declared all technology stocks to be speculative garbage and refused to even look at them for the next 2 decades. They sat on the sidelines while companies like Amazon, Google, and Apple created trillions of dollars in value. They were right once, and that single victory blinded them to a changing world. The stagnant expert's circle of competence doesn't expand, it shrinks. The world evolves, new industries emerge, and old ones decline, but their knowledge and toolkit remain frozen in time. They suffer from what psychologists call earned dogmatism. Their past success makes them overconfident and closed-minded. They are often the loudest critics of new technologies and new business models, dismissing them with cynical first-level thinking. Their portfolio becomes a relic of a bygone era, and their returns stagnate and eventually decline. They failed to heed the advice of Charlie Munger, who famously said, "If you're not willing to destroy your own best-loved ideas, somebody else will do it for you." The stagnant expert loves their old ideas too much, and the market eventually, mercilessly, destroys them. The direct financial connection of thoughtfully expanding your circle of competence is profound. It is the primary source of sustainable, long-term alpha or outperformance against the market. A static investment strategy, no matter how brilliant it was initially, will eventually see its competitive advantage eroded as the world changes and other investors copy it. The ability to learn and adapt is the only durable edge. Look at the evolution of Berkshire Hathaway's portfolio. For decades, its largest holdings were in banks, insurance companies, and consumer goods. But in the last decade, its single largest common stock investment has become Apple. This would have been unthinkable to the Buffett of 1999. This evolution was not a random act. It was the result of a deliberate, long-term process of learning, guided by trusted lieutenants and a willingness to challenge old dogmas. The financial impact is staggering. The investment in Apple alone has generated over $100 billion in unrealized gains for Berkshire shareholders. This monumental success would have been impossible if Buffett had remained the stagnant expert, forever trapped in the cigar butt world of the 1950s. On a personal portfolio management level, the expansion protocol allows you to participate in new waves of innovation and growth. By methodically learning about areas like cloud computing, artificial intelligence, or genomics, you open up new universes of potential investments. It diversifies your risk beyond the old economy stocks you might be comfortable with and positions you to benefit from the powerful secular trends that will drive the economy for the next generation. It is the bridge between a portfolio that reflects the past and one that is positioned for the future. It is the ultimate expression of a true investment mindset, the understanding that your most important asset isn't the stocks you own, but your capacity to learn. We have journeyed through the history of the most formidable intellectual partnership in business history. We have seen how the friction of two brilliant but different minds created a decision-making engine that built a trillion-dollar empire. We've seen how Charlie Munger's relentless questioning forced Warren Buffett to evolve, to pay up for quality with See's Candies, to anchor himself to integrity during the Solomon crisis, and to venture beyond his comfort zone with BYD. These are not just charming stories from the life of a famous investor. They are powerful, actionable case studies in the architecture of a resilient mind. Buffett himself has been the most vocal proponent of this idea, constantly giving credit to Munger for his role in shaping him. He once said, "Charlie has the best 30-second mind in the world. He goes from A to Z in one move. He sees the essence of everything before you can even finish the sentence." On another occasion, he summarized their entire partnership. "We've had a lot of fun. The only thing we've had a fight over in all these years is, we have a plane and he gets the better seat. But it's been a terrific partnership. It's not that we agree on everything. We've agreed on the big things. And we've had a lot of fun, and we've made some money, and our investors have made some money, and it's largely because we've followed a fairly simple roadmap that we laid out a long time ago and have had the discipline to stick with it." But the most telling quote, the one that serves as the foundation for this entire discussion, is perhaps the simplest. "I've been shaped by Charlie Munger. It's been a huge factor. I always say I'd have been a lot poorer if I'd never met him." This isn't just a compliment. It's a confession. It is the greatest investor of all time, admitting that his genius was not solitary. It was forged, tempered, and magnified by another. This lifetime of learning, this collection of anecdotes, points to one profound conclusion. The quality of your thinking is a direct reflection of the quality of the intellectual challenges you are willing to endure. The final psychological principle that underpins this entire framework is perhaps the most important of all: intellectual humility. This is not the same as self-doubt. It is the active, confident, and constant awareness of the limits of your own knowledge and the biases that shape your thinking. It is the opposite of the Dunning-Kruger effect, a cognitive bias where people with low ability at a task overestimate their ability. Intellectual humility is the mark of a true expert. The more you know, the more you realize how much you don't know. Warren Buffett, despite his legendary status, is a paragon of this virtue. His famous circle of competence is itself an act of intellectual humility. He is publicly stating, "Here are the areas where I am qualified to have an opinion, and outside of them, I am a novice." His partnership with Munger is the ultimate expression of this principle in action. He actively sought out and paid a partner whose primary job was to remind him of his potential for error, to challenge his assumptions, and to point out his blind spots. This is a radical act in a world that lionizes the lone genius, the visionary CEO who trusts their gut above all else. Buffett's success is a testament to the fact that the most powerful gut is one that has been systematically stress-tested by a rigorous external intellect. This practice is a form of metacognition, or thinking about thinking. It's the ability to step outside of your own mind and observe your mental processes as an objective third party. It's asking questions like, why do I believe this? Am I falling in love with this story? Am I seeking out information that confirms my bias? What is the strongest argument against my position? Most people live their lives trapped inside their own first-order thoughts. The leap to metacognition is the leap from amateur to professional, in any field. Building a mental team is a system for forcing metacognition. It institutionalizes the process of self-correction, making it a regular, expected part of your decision-making, rather than a rare event. Now we will synthesize everything we have learned into the ultimate practical blueprint, the personal board of directors model. Your mission is to build a small, trusted group of advisors, your own mongers, to help you make better decisions in your finances, your career, and your life. This is not a formal, legal board. It is a mindset and a personal system. Here is the step-by-step guide to building it. Step 1. The architect's role. Define your gaps. You are the chairman of this board. Your first job is to perform a ruthless self-assessment. Where are your weaknesses? What are your most dangerous biases? Are you overly optimistic? Do you get swept up in hype? Are you too risk-averse? Are you anchored to old ways of thinking? Write these down. This list of your personal cognitive flaws will serve as the job description for your board members. You are not recruiting your friends. You are recruiting to fill the gaps in your own mind. Step 2. The casting call. Identify your archetypes. You need to recruit for specific roles. You should aim for a board of 3 to 5 people. Do not recruit people who all think like you. The goal is cognitive diversity. Consider these archetypes. 1. The monger. The skeptic. This is your chief devil's advocate. This person should be naturally cynical, detail-oriented, and unafraid of conflict. They are the person who will read the fine print and ask the uncomfortable questions. 2. The visionary. This person sees the big picture and the long-term trends. They are your antidote to short-term thinking. They will challenge you to think bigger and to not get bogged down in minor details, pushing you to expand your circle of competence. 3. The ethicist, the moral compass. This is the person you call for the front-page test. They have a strong moral and ethical compass and can help you navigate gray areas, ensuring you protect your reputational moat. 4. The expert. This is your Sherpa for a specific domain you want to understand better. If you are a tech investor, maybe you need an expert in healthcare on your board, or vice versa. They provide the deep domain knowledge you lack. Step 3. The recruitment pitch. Approach your candidates directly and explain the concept. Be clear about what you're asking for. I'm building a personal board of directors to help me make better decisions. I've identified you as someone whose perspective I deeply respect, particularly in the area of skepticism/big-picture thinking/ethics. Would you be willing to be on my board and allow me to call you once a quarter to challenge one of my major ideas? People are often flattered to be asked for their honest opinion, especially when you frame it as a way of helping you avoid mistakes. Step 4. The board meeting protocol. Just as with the devil's advocate model, formalize the process. For any major decision, a large investment, a career change, a significant business move, you must run it by the board. This means sending a one-page summary of your proposed decision and your reasoning to the relevant board members. Schedule a call. During the call, your job is not to defend, but to listen and probe. Ask them, what's the biggest flaw in my thinking here? What am I missing? What would you do in my position? Step 5. Compensate and appreciate. Your board members are giving you their most valuable asset, their time and mental energy. You must show your appreciation. This doesn't have to be monetary. It can be a nice dinner, a thoughtful gift, or, most powerfully, offering to serve on their personal board in return. Acknowledge their contribution. After a decision, follow up and let them know how their advice influenced your final choice. This closes the feedback loop and makes them feel valued, ensuring they will be there for you the next time you need them. This system, this personal board of directors, is the ultimate tool for achieving a CEO mindset in your own life. It transforms decision-making from a solitary, bias-prone activity into a robust, collaborative, and self-correcting process. The antithesis of this structured approach is the lone wolf investor. This is the individual who believes they are a solitary genius. They trust no one's opinion but their own. They might read books and articles, but they internalize only the information that confirms their existing views. They see seeking advice as a sign of weakness. Their ego is inextricably tied to their investment ideas. When someone challenges their thesis, they don't see it as a helpful act of intellectual sparring. They see it as a personal attack. The lone wolf is dangerously susceptible to every bias in the book. They live in a perpetual echo chamber of one. They fall in love with their own stories, their own analysis, and they miss the obvious flaws that a fresh pair of eyes would spot in an instant. When they are wrong, the losses are often catastrophic because they had no one to tell them to cut their losses, to reevaluate their thesis, or to admit they made a mistake. They double down on their losing bets, convinced the market is wrong, and they are right. Their portfolios are often a story of spectacular flameouts. They might have a few big wins that fuel their ego, but their inability to manage risk and correct for their own biases ultimately leads to ruin. The lone wolf investor fails because they believe that investing is a battle against the market. The master investor knows that it is, first and foremost, a battle against yourself. And in that battle you need allies. The final, direct financial connection is the culmination of all the previous lessons. Building a mental team, a personal board of directors, is the single most effective risk management strategy you can implement. It directly impacts your financial outcomes in three profound ways. First, it leads to superior error avoidance. By systematically stress testing your ideas, you kill the vast majority of your bad ones before they can ever cost you money. This single act of prevention will save you more money over your lifetime than any brilliant stock pick will ever make you. Preventing a single 50% loss requires a 100% gain just to get back to even. Your board is your first and best line of defense against these portfolio-killing errors. Second, it improves your capital allocation. With a team of diverse minds, you will be exposed to a wider range of opportunities and will be forced to think more deeply about where to place your bets. You will be less likely to concentrate your capital in a single high-risk idea that you've fallen in love with. Your portfolio management will become more professional, more diversified, and more resilient. Finally, it creates the emotional fortitude required for long-term success. Investing is a marathon of emotional discipline. During inevitable market crashes, your board will be the voice of reason that keeps you from panic selling. During euphoric bubbles, they will be the anchor of skepticism that keeps you from getting greedy. This emotional regulation is the key to surviving the market cycles and allowing the magic of compounding to work for you. It is the bedrock of sustainable wealth management. Ultimately, creating this mental team is the final promise you make to yourself. It is the promise to subordinate your ego to the pursuit of truth, to value criticism over comfort, and to engage in the hard work of thinking. This path doesn't guarantee you'll be the next Warren Buffett, but it absolutely guarantees you will become a wiser, more rational, and ultimately, a more successful investor than you would have been on your own. It is the foundation upon which true, lasting financial freedom is built. You have just spent this time acquiring a powerful new weapon for your mental arsenal. You now have the blueprint for building a personal board of directors, a system for institutionalizing critical thinking and avoiding the catastrophic trap of the intellectual echo chamber. This is not a small thing. You have fundamentally upgraded your decision-making software. You have learned how the most successful partnership in financial history operated not on consensus, but on constructive conflict. And you now have a step-by-step process to replicate that dynamic in your own life. You are now armed against your own biases in a way that 99% of investors will never be. But a weapon is only as good as the warrior who wields it, and a board of directors is only as effective as the ideas it debates. Having a system for challenging your thinking is a monumental first step, but it reveals a critical knowledge gap. What are the powerful core ideas that you should be debating in the first place? Warren Buffett and Charlie Munger didn't just argue in a vacuum. Their debates were grounded in a shared library of powerful mental models, frameworks for valuing a business, for analyzing a competitive moat, for assessing management quality, and for understanding market psychology. The video that is now on your screen is the next piece of that map. It is the link that connects the process of thinking, which you have just mastered, with the substance of thinking. Think of it this way. You have built the perfect forge. That next video is the high-grade steel you need to create truly formidable ideas. It represents the intellectual ammunition for your new mental team, the frameworks you and your board will use to dissect and analyze opportunities with a level of clarity and precision you never thought possible. The choice you face is not simply whether to watch another video. It is a choice about who you want to become. Are you content with simply having a better process? Or are you committed to becoming the kind of thinker who can supply that process with world-class ideas? The path of continuous improvement is a deliberate one. The journey to complete your mental arsenal is not for everyone, but for those who are serious about achieving mastery, the next step is clear. Complete the connection. Click and continue your ascent.